Welcome to Chapter 21, Partnerships, in our first online meeting. As you notice from your reading, Chapter 21 is relatively lengthy. Accordingly, I decided to split the lecture videos into two parts. In this first video, we'll examine what's a partnership and how is a partnership formed. So what do I mean by a partnership? I don't mean a domestic partnership, as with Oprah and Stedman. I mean an association formed by two or more persons with the intent of earning a profit by carrying on a trade or a business. In exchange for money, property, labor, or skill, each partner expects to receive a share of the corporate profits. Partners can be any quote-unquote person, be it an individual tax filer, a corporation, a trust, or an estate. However, the entity itself must be unincorporated. The entity cannot be a corporation, trust, or estate. And finally, partnerships, like sole proprietorships, are flow-through entities. The partnership carries on the business, and the major transactions flow through to the individuals. We'll talk later about what this means. There are several types of partnerships in existence, and they vary depending on the type and the number of each partners. Let's look at some of these differences in a general partner and a limited partner. A general partner is involved in all company decision making. They're tasked with operating and conducting business for the organization, whereas a limited partner is not. A general partner is liable for personal debt in the partnership. That is the debt that they contributed, the debt they incurred themselves, as well as all entity debt. A limited partner is liable only for those agreed upon partnership debts, either debts that they contribute to the partnership, debts that they contract for, or what they contributed to the partnership itself. Now, while all partnerships are conduits through which business transactions flow to the partners, when the partners are individual filers, additional taxation layer occurs. A general partner who is an individual taxpayer is subject to the self-employment tax. A limited partner is not. Accordingly, the IRS tends to be skeptical of limited partners who quack like a duck, walk like a duck, and act like general partners. Now, what makes the difference between some of these popular partnership forms? If the partnership has only general partners, a general partnership. General partnerships have two or more general partners who are each involved in the decision making, who are each involved and responsible for paying the debt, and if they're individuals, are each subject to the self-employment tax. If a partnership has at least one general partner and at least one limited partner, it's called a limited partnership. The general partner is wholly liable for the partnership debt, whereas the limited partner is only liable for their own contributions. A hybrid form exists if two or more member or partners have traits as both general partners and as limited partners. The most common forms are the limited liability company and the limited liability partnership. The two types of hybrid partnerships that the textbook discusses are limited liability companies and limited liability partnerships. My friend Kimberly's business, Sugarista, is a limited liability company. She chose that business ownership form because she didn't want creditors coming after her personal assets, only after the business's assets. But she wanted to retain full participation in decision making. A disadvantage that the textbook discusses with regard to limited liability companies is the fact that they're still relatively new. Accordingly, there's not much case law and precedent when it comes to determining tax treatment of the LLC. Most of the major law firms and accounting firms operate as limited liability partnerships. They're managed and operated like a general partnership. Each partner is liable for the partnership's contractual obligations or the debt that the partnership incurs to perform partnership operations. However, individual partners are not liable for the malpractice of their partners, only for their own malpractice. This means that if a partner commits a fraud, gets sued for malpractice, then the other partners aren't on the hook for their malpractice. Now, as we said earlier, partnerships are a conduit. Individual partners, be they corporations, other partnerships, estates, or trusts, contribute time, energy, and money to the partnership. The partnership conducts business, and the partnership returns profits to the individual contributors. I'm going to illustrate the aggregate and the entity concept using the characters from The Office. If you're a fan of the show, you may remember in one of the seasons, Michael Scott and some of his associates got fed up with the corporate BS, so they decided to start their own company. Let's imagine that this company is a partnership. The aggregate theory of partnership states that partnerships are a collection of taxpayers that are joined in an agency relationship. The individuals in the partnership seek to earn a profit, and they seek to protect each other and protect the partnership's interests. But the partnership is also an entity in and of itself. The partnership makes decisions on certain business items, and those business items are explicitly relevant to the entity. Combined, we see how the tax laws are structured to reflect both the aggregate and the entity theory of partnerships. Certain partnership rules apply to the aggregation of partners, and certain partnership rules apply to the entity as itself. Now we can think of the aggregate and the entity using the accounting equation that you learned in your very first accounting class. Assets equal liabilities plus equity. But instead of thinking about this from the accounting equation perspective, we're going to think about this from the perspective of the inside basis, which is the assets and the liabilities that comprise the partnership and are owned by the partnership, and the outside basis, which is each partner's individual basis in the partnership. What they put in to the partnership is equal to the assets within the partnership. And that's what this last paragraph says. The partnership records both partnership transactions, so the revenue making functions and the expenses that go with those revenues that are applicable to every partnership decision. But partnerships also include separately stated items. These are items that, depending on what type of tax filer is recording the items and their personal income tax preferences, the transaction itself could impact the partnership or the partner differentially. A key thing to remember about partnership basis and partnership ownership is just like we saw in the assets equal liabilities plus equity formula. The partnership's inside total basis in all assets must equal the partner's outside basis. The aggregate partnership reports an informational return that summarizes that information that's related to the partnership's operations, as well as those separately stated items. In turn, each partner typically owns a capital interest and a profit and loss interest in the partnership. The capital interest is measured by the partner's capital sharing ratio, so how much they kick into the business, whereas the profit and loss interest is what percentage of the profits that individual partners will get. Now, this can be equal to each other, the capital interest and the profit and loss sharing, but they can also be disequal to each other. Is that a real word? Disequal? It works. So when a partnership is formed, partner contributions are generally tax-free. We saw this when we looked at corporations. What a partner kicks into the partnership is considered a direct transfer and is not subject to gain or loss. The partner takes a substituted basis in the partnership interest. The partnership takes a carryover basis in the assets it receives. Now let's think about what that means. Let's say Michael Scott contributed antique desks to their spin-off company that were valued on the books at $8,000 and could be sold at market rate for $20,000. The partner, Michael, gains $8,000 as a share of the partnership. The partnership takes the carryover basis in the assets. The partnership now has $8,000 worth of equipment on the books. Michael has a share of a partnership worth $8,000 on the books. But Dr. T, you say, his desks, he could sell them at market price for $20,000. What then? When the corporation sells the desks, if they decide to sell the desks, Michael would recognize a gain. Now let's say the corporation sold the desks for $25,000. In that case, Michael would be personally responsible for the $12,000 gain between the basis when he contributed the desks and what the desks were worth when he contributed them to the partnership. He would take his portion of the remaining $5,000 as additional gain. Now, since this is a tax rule, there are of course exceptions. Marketable securities. When a partner contributes these to a partnership, the partner generally takes the market value, the gain or the loss, immediately because there's just too much unpredictability about what can happen with a security. Another is contributions disguised as a sale. If a partner contributes property and then sells it immediately thereafter, the IRS will think it's actually a sale, in which case they'll hit the partner for the immediate gain treatment. And finally, services. As we saw with our corporations, contribution of services are generally compensated as ordinary income. Now let's talk about the holding period. When a partner contributes a new asset, the holding period of the partnership basis is contingent on the type of assets contributed. If it's a capital gain property, it's a capital asset and it takes the basis. If it's other property, it's as of the date of the partnership incorporation. For the partnership itself, the holding period on the asset includes whatever time period the asset was held prior to being contributed to the partnership. Now let's talk through a couple of other issues related to contributed property. First, depreciation method and amortization. The partnership generally steps into the shoes of the contributing partner and assumes their depreciation schedule and calculations. So if Pam Beasley contributed printers, the new partnership would use the same schedule for depreciation as Dunder Mifflin did. Likewise, if the new partnership carried in some goodwill from when Sabre acquired Dunder Mifflin, this would follow the same amortization schedule as before. Finally, The character of gain or loss triggers the treatment of this contributed property. For instance, a partner can contribute inventory that carries the ordinary income property, in which case there's no gain or loss, only income. For capital loss property, if the property is contributed with a known capital loss and then dumped within 5 years of the contribution, it triggers a capital loss when it's sold or ditched, but the loss is limited to the built-in loss amount that's known when the asset is contributed. Certain partnership decisions are made by the partners, whereas others are made by the entity. For example, partnership decisions include what taxable year to use, what method of accounting to use, how to treat organizational expenses and startup expenses, what depreciation methods to use, what inventory method to use, and how to treat R&D expenses. The common theme here is that each of these items, the treatment is entity-wide. Individual partnership decisions pertains to how to deal with the loan amount and the property value of any property they contribute, which is something individually based, and whether to take a deduction or credit for taxes paid to foreign jurisdictions. The partnership may incur these transactions, but because their treatment depends on what type of filer you are and what your own personal preferences are, the individual partner is ultimately responsible for determining its course. So let's talk quickly about some of the specifics of these costs that are incurred by the entity itself. Initial costs of a partnership include the organizational and startup costs. We talked about these in our discussion of corporations. They're treated in largely the same way as corporations, meaning that the first $5,000 of each category can be immediately expensed and the rest amortized. Syndication costs, which are costs incurred to promote and market the partnership interests, are capitalized. And then any depreciable assets that are acquired for new purposes or improvements made to contributed assets take on their own maker's schedule. Another decision that the partnership makes in and of itself is what type of accounting method to use and the timing of the accounting year. Partnerships can't use the cash method of accounting if at least one partner is a corporation or the partnership is a tax shelter. But being that this is tax, there's always an exception to the exception. If the corporate partner could use cash accounting in its own operations, then the partnership can also use cash accounting. Partnerships generally take the tax year of the partners. There's a complicated way to determine this. As long as you know that it comes down to when the partners have their tax year, you'll be fine.